If you feel like you missed out earlier this year when stocks went at an all-time low, I'm here to tell you that now is as good a time as any to get started with dividend investing. Remember how the old saying goes, time in the market is far more important than trying to time the market. Plus, everybody on YouTube is talking about how the stock market crash is probably going to happen again in the future anyways. So in the end, it doesn't really matter. The most important thing that you want to start doing is get started with investing today. A good stock is always a good stock regardless of where the market is right now. In today's video, I'm going to be giving you guys 3 dividend stock picks that you can take $3,000 and invest into. Now, I think all 3 of these stocks are pretty decent picks, and I think they have huge potential to do well going into the future. If I was starting over from scratch and I had $3,000 to invest, I would take that money and divide it evenly amongst these 3 stocks and put $1,000 worth of shares of each of the following 3 stocks that I'm going to recommend to you. So I'm going to give you guys my 3 stock picks right here, right now, and then we're going to dive into each one individually as we go through the video. So the very first one that I recommend is Rio Can. The second one we're going to talk about is Fortis, and the third stock is going to be a Canadian bank called RBC. So let's dive a little bit deeper and see why all 3 of these stocks are pretty solid buys right now. And really quickly guys, if you guys are enjoying this video, please give it a big thumbs up and subscribe to the channel if you guys want to see more Canadian dividend based investing content here on YouTube. So first of all, Rio Can Real Estate Investments Trust is the second biggest largest REIT in Canada right now, just behind Canadian apartment properties. Rio Can has over $14 billion worth of assets, and they own 289 retail properties as of today. Rio Can also focuses its properties on the 6 largest cities in Canada, which means that if there's going to be a demand for real estate going into the future, I do believe that Rio Can will be where the competition is, and they'll be able to take advantage of the need for real estate. And although a lot of people are talking about the Canadian real estate saying that it's probably not going to do well, or we're not sure what's going to happen, I am a firm believer that real estate will continue to do well in Canada regardless of the stock market crash that we had earlier this year. So the main reason why I think Rio Can is such a good buy right now is because as of right now, it's trading around under 40% of its value that it was trading at pre-market crash. This means that you can buy this REIT at almost 50% of what it was worth before the stock market crash in early March. To me, this makes me think that Rio Can is a very undervalued REIT, and I think that it will rise up and get a lot of its value back over time. And because of such a discount, I think this is the #1 Canadian REIT to buy as of right now. And it's also important to mention that Rio Can has one of the biggest dividend yields in all Canadian REITs, sitting at around 8% as of right now. That's pretty big. And of course, that means that if you invest into Rio Can and you hold it for a couple years, there's huge potentials for returns to come over the next coming years. If you want to buy Rio Can, it's currently trading at about $15 Canadian per share. And if you were to stick $1,000 into Rio Can, you would be able to buy about 63 shares of Rio Can. So if we took Rio Can's current yearly dividend yield of $1.44 and times it by 63, it would give us about $90 in dividend gains at the end of the year. So this means that if you invested $1,000 into Rio Can today, you would get about $90 in just dividend yield alone. The next stock we're going to talk about in this video is going to be Fortis. Now, I've talked a lot about energy and utility stocks in the past, and I've talked about Enbridge a lot on this channel, but I haven't really talked too much about Fortis. So in today's video, we're going to talk a little bit about this utility stock, and I'm going to give you guys my opinion on whether or not I think it's a good solid dividend stock to invest into. Now, the nice thing I like about Fortis is that it's a well-diversified international utilities stock. Fortis operates mostly out of Canada and the US, and they've done a really good job of growing and remaining a strong utility stock, while other utilities and energy stocks have taken a bit of a rough time over the past little while. Now, although Fortis has recovered quite a bit since the market crash and their stock price is up there quite a bit, I still think it's undervalued, and I think going into the future, it's a good buy. In fact, because of the fact that it went up so much, I think that just shows that Fortis is a nice safe stock, a nice safe dividend investing growth stock to invest into the future that will do well. And I always like to have a consistent portfolio that has maybe some higher riskier stocks, some more consistent stocks, and Fortis would be one of those more safer, consistent dividend stocks that I would love to stick in a portfolio. And I think if you bought about $1,000 worth of shares of Rio Can, then you stuck $1,000 worth of shares of Fortis, you're doing a nice good job of balancing out that risk versus reward type scenario. Now at the time of recording this video, you can currently buy Fortis at $51 a share. And if you spent $1,000 on Fortis stock, you'd be able to buy 19 shares of Fortis. And after 1 year investing in Fortis, you would end up with $34 in gains just from dividend yield alone. Overall, I think Fortis is a nice utility stock to invest into, and I think it's a nice safe bet and a nice way to diversify a portfolio. Alright, so the last stock on this list that we're going to talk about today is RBC, or Royal Bank of Canada. Now, you could basically stick any Canadian bank in this slot here, but I've been talking a lot about TD and some other banks on this channel a lot, so let's kind of just talk about something a little bit different. And today we're going to take RBC and we're going to talk about that stock, but realistically you could stick any Canadian stock here and it'd do just as well as RBC. So first things first, it's worth noting that RBC has been in the bank business for over 150 years. RBC also impressively has business in over 40 countries outside of Canada, which gives it nice international exposure around the world. And currently at this time of day, RBC has 1.49 trillion in assets alone. Now, although banks in Canada are having a pretty rough time right now, and going into the future, they're probably going to have difficulties even more so, I think now is also a great opportunity to buy some of these bank stocks, these really consistent, solid bank stocks, at a nice cheap price. And of course, even though RBC has risen up a little bit in value since the market crash, I still think it's a pretty solid buy right now, especially if you're a dividend investor. RBC, also just like all the other Canadian banks, also has a really nice solid dividend yield. Their dividend yield is currently sitting at about 4.68% as of today. RBC is also one of the banks that also managed to raise their dividend at the start of the year, and not only that, but they actually managed to maintain their dividend, and I think going towards the end of the year, they will most likely keep their dividend where it is at. This is a good thing because a lot of companies right now are cutting their dividends, and you want to be investing in solid companies that are going to keep their dividends, in fact even grow them as time goes on. If you put $1,000 into RBC stock as of today, you'd be able to buy about 10 shares of RBC. And if we take that number and multiply it by their annual dividend yield, you would make $45 in dividends alone from RBC as of right now. In conclusion, I think all these three dividend stocks that I mentioned in this video are solid buys if you want to invest in Canadian stocks right now. My high risk move today would be to invest in Rio Can, but I also think it's important to diversify. So if you want to invest in Rio Can, that's fine, but consider picking up one of the other stocks I mentioned in this list, or maybe consider getting them all equally, because I think diversifying and help reducing that risk is more important in the long run. So before I end this video, guys, I just want to say thank you for watching. If you guys enjoyed this video, be sure to give it a big thumbs up and subscribe to the channel if you guys want more Canadian-based dividend investing content. Now, before we end this video, I just want to say, please in the comments, let me know what 3 stocks you would invest to if you had $1,000 to invest into today. Let me know in the comments section, and thanks for doing that, guys. Thanks for joining me today, guys. I hope you guys enjoyed the video, and I'll see you guys later.